In today's video, we're going to answer some more of the most common questions we get regarding how you can use Section 179 assets, specifically tiny homes, to not only reduce taxes on $1 million incomes, of whether that's W-2 income or Roth conversion income. Again, if you're looking at a $400,000 tax bill, you can use this Section 179 hack using tiny homes to take that tax bill all the way down to zero. You can do it legally. You can do it this year. Question is, number one, how can I make money with my tiny home rental business? The idea is that you start an LLC, you go out and you purchase one of these tiny homes, it's Section 179 eligible, and you get that unit financed. You get in-house financing from the manufacturer. So if the cost of the tiny home is $375,000, you're putting $100,000 down, and you've got in-house financing, 0% interest for the next 30 years. And the cost on that is roughly $750 a month. On the same day that you sign the purchase agreement, so they're extending you this line of credit, this financing with the asset as collateral, you're turning around and you're signing a third-party leasing agreement where they agree to lease the tiny home from you, and they'll pay you $860 a month for 30 years. And it's guaranteed by the parameters of the leasing contract that says it's non-cancelable by the third-party leasing company. So you put $100,000 of monies down, you get financing for $760 a month, and then you're turning around and leasing this tiny home out for $860 a month. You're making $100 a month of net income. This third-party leasing company is taking care of the insurance, the tenants, the repairs, the damages, the marketing, the transportation costs, everything involved with this tiny home. They have a hold harmless clause and an indemnity clause that's included there. So if a tenant does something crazy and wrecks the property, they indemnify you for it. So that's how you make money on the income side. And obviously, if you were spending $400,000 of monies in taxes, and we can take that tax liability down to zero, then you can go and invest the money. For every $100,000 of monies that you spend on one of these tiny homes, you'll save about $140,000 to $150,000 of monies in taxes. So that's the differential, somewhere between $40,000 and $50,000 of your net benefit. Question number two, what's the market outlook for these tiny homes? Well, the market outlook is very, very strong. The municipalities across the country are changing their zoning laws, allowing these tiny homes to be added in as accessible dwelling units. So the space is expanding by leaps and bounds. In the transitory marketplace, what's the opportunity to provide these tiny homes for transient workers in the oil and gas fields? Well, that really is kind of the Shanghai law that's going on right now, because the management company is opt to offer this lease contract to you, because in your case, you're signing a leasing agreement and you're paying the $760 a month, and the company is paying you $860 a month. Well, they're turning around and they're leasing that unit out and they're making $3,000 a month. So there's ample profits to be made by the leasing company, but it really is kind of a win-win-win, because the tenant that's staying there has a much better place to live instead of staying in their truck or staying in some cramped man camp. And you're making money because you got the tax benefit and are making money from a monthly income side, and the third-party manager is making money. It's a great setup. You're helping to avoid the housing crisis. How can I purchase the tiny home to reduce my tax liability? I think we talked about that. You can purchase that. Obviously, if you've got over $100,000 of monies in taxes, for every $100,000 of monies that you spend, you'll save $140,000 to $150,000 of monies in taxes. So that's kind of the break point. If you got $100,000 in taxes, give us a call and let's see if we can offset it. How does the tiny home qualify as a Section 179 asset? What is unique about it? It qualifies because it's not real estate. It's classified as business equipment, and the functional use of this equipment is being used to provide temporary housing in transient lodging for 30 days or less. So there's 3 different tax court laws that back this thing up. One as recent as 2014. There's one from 2004, and one goes back to 1970, where this idea of providing housing in the transient lodging short-term industry has been challenged, and they've won all 3 of those cases. How can the purchase of a tiny home save me taxes on $1 million Roth conversion? When you convert a Roth IRA, that's viewed as ordinary income. So $1 million conversion, you're going to pay in income taxes. That's, again, you can buy 3 of these units and offset that Roth conversion income completely. If you're already planning on paying $400,000 in Roth conversion taxes, a lot of you are, and you've got multi-million dollars in Roth conversions, you can get a 2-for-1, right? Just do a $2 million conversion for the same amount. Where in the tax code does it say that W-2 income can be offset by a Section 179 deduction? You need to go to the forms and instructions page, Section 4562, I believe. Instructions for Form 4562, line 11. There it states that the individual's income, if they're filling out this form, the Form 4562 is what business owners fill out, claim Section 179. So the type of income that can be offset by this, and obviously it's business income, and there they state that it's W-2 income, salary income, specifically that income that is listed on 1040 line 1. So that's where you go in the tax code is Form 4562. You can find it on the IRS's website. Can I buy more than one tiny home to increase my tax savings? Yeah, of course. You can buy 3 of these. The limit is 1.2 million. That's a household limit. So you can't buy 1.2 million for yourself and 1.2 million for your spouse or anything. How much W-2 income can I offset with qualifying sections? Again, same thing, $1.2 million. Is taking a Section 179 deduction against my W-2 income legal? Will I get into trouble with the IRS? Yeah, it's legal. You're starting a business, right? This is not an investment. You're starting a business, and you have to show that you're actively involved in this. In this case, the business that you're going to be in is renting out tiny homes, providing lodging for individuals in the transient industry. And to be actively involved in that, you should be engaged in monitoring these lease agreements. Although you're hiring the third party to do that for you, you can monitor that process and be actively involved in the management of that process by having monthly meetings with them, quarterly reviews of all the tenants that are there. They have Ring cameras that are installed on the units. You can log in and review what's going on in your tiny home on the Ring cameras. You could fly down and stay in the units as well if you wanted to. And that's why I say the only reason that people could possibly get into trouble with this, as I see it, is that they've claimed a business expense and they're not tracking their records, right? It's the same problem that you would have if you go out to eat on a business lunch and you don't keep your receipt from the lunch. That's going to be a problem. What are the tax laws surrounding a qualifying Section 179 deduction? And are there any case laws? Yeah, I covered that. The case laws, again, from 2004. There's a Shirley versus the commissioner was a big one that was there. I'll have those in the link below. Explain the leveraged Section 179 tax deduction strategy. What does that mean? Well, a leveraged Section 179 deduction strategy is exactly what we're implying. An individual is putting $100,000 of monies down and they're getting a $375,000 deduction. So you don't have to finance your asset if you don't want to. I mean, you could buy the asset for $375,000, but the idea is to put as little money down as possible, and then you're investing the difference. That's where the leverage Section 179 comes from. When can I expect to start making money on my Section 179 tiny? Well, you can start making money the very next month. We have contracts in place where these units can be placed and you'll start making money the very next month. How do you get started? What are the steps involved? How long does it take? Well, you have to set up an LLC, and depending on the state that you live in, you can go to your state commissioner's website, your business commissioner's website, and set up an LLC in 2 days. All you need to have is a federal tax ID number. You can get that for free at the IRS website. That's where you'll pick the name of your entity, and then you have to go and register as a new business in the state that you live in. You'll want to do this as a single person LLC. That's the best way to do it. So a couple who's married, they're treated as a single individual. So you can do a single person LLC, set that up. It usually takes 2 days to get that established. Some states do it for $30. Some states do it for $100. Once you have your business documents set up, then you'll go into a bank, open up a bank account, fund it, and you can wire the funds in to purchase your tiny home and get the deduction. It is time sensitive. If you're trying to do it by the end of the year, the units need to be in place by December 31st. So the sooner the better. No. This is not an investment at all. This is a business. You're starting a business. You're getting a tax deduction as a business owner for business equipment that you're purchasing. You're financing that equipment and getting the full amount of your purchase price. What are the most common questions CPAs ask about the Section 179? They ask about the laws that are surrounding it. They ask, a lot of them don't know that you can use it to offset the W-2 income. They want to know how long it's been on the books for. I mean, Section 179 has been in the code for 40 or 50 years. The case law is very solid on Section 179. What are the consequences of not doing a Section 179 purchase to reduce your taxes? Well, the consequences are twofold. Number one, you'll have to pay that dollar amount of monies in taxes. So if you are a W-2 employee, think about this. You're a W-2 employee. You've already spent $400,000 of monies in taxes if you've been going through a payroll reduction, every month that you've been paid. So you've already paid $400,000 of monies in taxes. It's a sunk cost. You can plug in the Section 179 strategy, even if it's in December of the tax year. You can plug this in and you can wipe out that entire $1 million of income that you've got, and you'll end up getting a $400,000 refund. That's phenomenal. When we run the numbers for folks that have $1 million or $1.2 million of monies, for every $100,000 of monies that you spend on one of these tiny homes, you're saving about $140,000 to $150,000. So 2 or 3 of these units will save you $80,000, $90,000, $100,000, $150,000, depending. We can run the numbers for you individually, but you've got that opportunity cost of what that money could grow for you at the amount that it could grow for you moving forward if you didn't waste it in taxes. And I say waste it because, let's be honest, who's going to be a better steward of your money than you? If you have a choice of saying, oh, I'm going to give $400,000 of monies to the government because I think they're going to make wise decisions with those monies, or you could take that $400,000, invest it into yourself, start a business, a cash flowing business, right? Where you're getting this in-house financing and you're getting a third party who's coming in and indemnifying that purchase agreement. They're paying the cost of your financing for the next 30 years. That's a win-win. I like that. On an extreme example, you could look at an individual that might make $50 million of monies in any one year. They're not paying a 40% tax on that $50 million. They're going to go out, put their thinking cap on, and they're going to go buy a $50 million asset. With the Section 179, you're limited to the amount that you can expense, but the principle is the same. $1 of income, we're going to go buy a $50 million Gulfstream 650 jet. And we would have had to have paid $20 million of monies in taxes. But now that we're buying the jet, we're going to buy it with financing. So we're going to put $5 million of monies down, and we're going to finance the $45 million difference. Your financing cost on the $45 million is $200,000 a month. Okay. So you save $15 million of monies in taxes. You can invest that money for growth. You've got a $200,000 a month payment. Well, the jet can rent out for $400,000 or $600,000 a month. The average usage on this jet is 400 hours a year. So you're going to be net positive by $200,000 to $300,000 to $400,000 a month on the asset that you're using to not only reduce your taxes, but in this situation, it's making you money. So we see successful business people that do this, that make tens of millions of dollars. And we say, oh yeah, that makes sense. They understand the tax code. But in our own situation, right, we don't do that. We just do what normal folks do. And they just pay their taxes. And they make $1 million and they pay $400,000 of monies in taxes. I'm stating, let's use the poor man's version of the jet, use Section 179, put $100,000 down, save a couple $100,000 of monies in taxes, invest the difference, start a profitable business, employ your kids, employ your spouse, and use this business to help offset other expenses that you may have in your life. I love it. If this is so good, why isn't everyone doing it? I have no idea. I guess the same question could be posed to if you have legal and legitimate itemized expenses in your tax return, why doesn't everyone itemize their tax return? The majority of people just do the standard tax return because they think it's too complicated, they think it doesn't apply, or they just don't understand. And in reality, there's really 2 types of tax codes. There's the tax code for the wealthy, right? That they understand how these things work, like this business jet example, right? $50 million of income, you were going to have to pay $20 million of monies in taxes, but you bought a jet. That jet offset the $50 million of income. So now you paid zero in taxes. The monies that you would have spent on taxes, you take $5 million, you buy a jet, you get it financed, and you rent the jet out. Therefore, the monies that you're making from the rent of the asset not only cover your financing payment, but they make you money every month. So it's kind of like a long-term loan from the IRS. Again, for wealthy people do that all the time, and we say that's great, but we don't adopt those same principles in our own life. My CPA doesn't know about any of this. What should I do? Well, you should tell them to watch these videos, and you could send them the white paper. I'll include a white paper here below that has some of the tax court law that these things are based on. It's not very complicated. I mean, Section 179 is not new. You probably have an accountant who prepares your taxes, right? They don't do forward-thinking planning strategies to reduce your taxes. That's probably the difference. So get a new accountant, or call us, call our team, and we can put you in touch with someone that can help you out. Hope this video has been beneficial for you. Click on the link below, like, subscribe, stay tuned for more tax-saving tips on how you can make smart decisions with your monies using Section 179 to reduce your tax liability from $1 million. Thanks.